Okay, welcome back and good afternoon to everyone to our Options Education Weekly webinar series. Today we have a pretty special webinar for you guys.
Welcome back and good afternoon to everyone
We have a pretty special webinar for you guys. Today we're going to be talking about how to maximize your income with credit spreads. Now, I'm doing this webinar this week at 12 o'clock instead of 4:15 because we have a pretty special announcement to announce to everyone about the work that we've been doing on the quantitative side with understanding credit spreads, generating new trade ideas for those of you that follow some of our daily plays into strategies that many of you trade, which is credit spreads. So today I'm going to go over quite a few things regarding the strategy itself, how to go about utilizing them, more importantly, how to leverage them using options play. But today we're going to announce at the very end of this a new service that we're launching for helping you guys trade credit spreads. So we're launching a brand new trading idea service through StockTwits. For many of you follow us through StockTwits, that's going to be generating daily credit spread ideas. So we'll go through that at the end of the webinar, showing you what that's going to look like so that you have a preview of that before you can decide whether that's a service that you want to subscribe to or not. So before I get started, just a bit of housekeeping. This webinar is going to be recorded. We have the slides available for everyone to see the slides as part of the recording that we'll send out about half an hour later. There's some important links in those slides I highly recommend for those of you that are new to options play to make sure you take a look at. The webinar recordings, I'll reference that a few times during our webinar as to some of the previous recorded webinars and some of the topics that we're going to be talking about here today. So if you want to check out some of those webinars, make sure you click on some of those links, as well as important links on our daily trading ideas subscription for options play. And for those of you that are brand new to options trading, I highly recommend you to take a look at a website called the Options Industry Council, a very great group that's sole job is to educate you on options, and it's non-for-profit, so they're not going to sell you any services or anything like that. So it's a great resource for those of you that are looking to learn about different option topics. So if there's something that you hear about today that you want to learn more, the Options Industry Council is a great resource for you to learn just about everything you can possibly think of regarding options. So today, like I said, this is a fairly special webinar. We're doing this at noon during the market hours because I want to show you guys a few things that we're launching. But the first half, what we're going to do is we're going to talk about credit spreads. What are credit spreads? When is the best time to use credit spreads? How to trade them effectively? What we've done is we've done a lot of back testing over the last few months on all different types of credit spread strategies, different expirations, different strike prices, different take profit models, and what we're here is to share with you some of those findings from all of these thousands and thousands of back tests that we've done on credit spreads. So we'll talk about what are the optimal spreads that we found to enter and how to manage them properly based on our back testing. And then what we'll do is we'll go over to options play and show you some real symbols in setting up some of these credit spreads based on the methodology that we're going to explain today. And at the very end, what I'm going to do is I'm going to show you guys the options play credit spread signals that we've just launched. This is a new signal service to send you daily trade ideas just on credit spreads. Many of you follow our daily play ideas that we send out every single day. For those, we send out debit spreads. Many of you have told us over the last few months that you use credit spreads. It seems to be the most widely used strategy here by traders. So what we've decided to do is really spend some time to figure out what are the best signals for credit spreads, and more importantly, what are the optimal credit spreads to trade off of those signals. So what we've done is we've automated all of that work that we've done into a single service that you can subscribe to and just get the signals for which stocks and which credit spreads to sell. So we'll give you guys a little preview of that and show you how to sign up for those of you that are interested. So I'm going to start off by talking about what are credit spreads, but before I do that, I just want to do a quick poll here. How many of you utilize credit spreads today? Do you trade credit spreads, or do you only trade other strategies, or are you completely brand new to options trading? Okay, so it looks like about 2/3 of you currently utilize credit spreads, but almost 40% of you either trade other option strategies or brand new to option strategies. So a good chunk of you are still new to this strategy. So I'll spend a little bit of time um, discussing what what a credit spread is, really diving into it. And hopefully many of you that even trade credit spreads will learn something new, because there's always some pieces of credit spreads that I see some traders may not truly understand. So I want to make sure that everyone really understands the how to set up a credit spread, what are the benefits of credit spreads, before we move on to what are the optimal credit spreads to trade. So as you can see, 60% of you trade credit spreads. So, clearly the vast majority here, but about 40% of you trade other strategies or are new to options trading. So for those of you that are brand new to options trading, welcome. I hope this inspires you to consider taking a look at options as an alternative to buying stocks or whatever other strategies that you're currently trading. And for those of you that are trading other option strategies, especially debit spreads, hopefully this also inspires you to take a look at this other way of trading, because it is quite different from debit spreads and it is useful in other market conditions when debit spreads may not be great for trading. So it's really good to have this strategy in your toolbox depending on the market conditions. And we're going to talk about that as well. So I'll talk about what our credit spreads are. I'll start off by what are credit spreads. There's really two spreads that we need to consider when we're talking about credit spreads. There's a bullish strategy and a bearish strategy. And credit spreads are basically the inverse of debit spreads. So instead of trading a long call vertical, you are trading a bull put spread as the bullish credit spread, and then a bear call spread as the bearish credit spread. So what do these two mean? I'm going to break this down so that everyone's completely clear as to what these two strategies are and how to construct them and when to use them. I'll start off with the bullish example here. Now, before I go into how to construct a credit spread, I want to make sure for those of you that are brand new to this strategy, you understand that this strategy has limited risk and reward. So very similar to debit spreads from that perspective. And the benefit of having limited risk and reward is that you know exactly what your max profit is and what your max loss is before you get into a trade. And this makes trading a little easier because you're already planned for what is the best and worst case scenario going into a trade, which helps remove sometimes the emotions out of trading, because you know exactly what you're going to expect. So no matter what is really not going to throw you off from an emotional standpoint. So even if you lose money, you already knew how much you were risking on that trade. Nothing will come as a surprise. So I generally find strategies that have limited risk and reward really good for the psychology of trading, which is something that we don't talk a lot about, but our emotions is one of our biggest factors in how we decide we trade. So defining your risk and reward really helps you set up your trades properly. So what I'm going to do here is I'm going to use stock XYZ, a fictitious stock trading at $100. Typically, I hate using these fictitious examples because people really find that difficult to translate that to real symbols. But from the perspective of teaching you how the strategy is constructed, a fictitious stock many times is useful. And then what I'm going to do is I'm going to go through some real examples using options play so that we make this a little bit more make these examples solidified in the examples that we provide. So what I'm going to do is I'm going to have stock XYZ trading at $100. Let's say I'm bullish on this stock. I think it might go up to 102, 105, 110, or I think it might stay exactly where it is. That's really when you want to use a credit spread. So a short put vertical is the bullish credit spread, and it's constructed by selling an at-the-money put, roughly, let's say for stock XYZ trading at $100, I'm going to sell the $100 put, the at-the-money put, and let's say I collect $4 for that put. What I'm going to do is, because buying a put, or selling a put rather, has unlimited risk, and I don't want to have unlimited risk on this type of strategy, what I'm going to do is I'm going to buy a lower put, let's say a $90 put, and that cost me, let's say, $1. So what that means is that my net credit on this trade is $3, because I'm collecting 4 on those short 100 put, and then I'm paying $1 on the long $90 put. So my net credit here is $3. And what that means is that I have a max reward of the $3 that I collect on this particular trade, and I have a max risk of $7. And $7 is calculated as the width between the buy and the sell leg. So the 100 strike versus the 90 strike is $10 apart. and that $10 represents our total opportunity. So if our max reward is $3, then the remaining amount of that $10 is our max risk. So all debit spreads and credit spreads is just the difference between max reward, max risk that adds up to the total width between the buy and the sell leg. Now, this is an interesting strategy because most other strategies requires you to have a directional view on the underlying stock. With credit spreads, you actually don't really need to have a strong directional view to trade this, because this trade will actually be profitable as long as XYZ stays above $97. That means if XYZ stays exactly at $100, this will be profitable. If it goes up to 102, it'll be profitable. If it goes up to 105, it'll be profitable. If it goes down to 98, it will also be profitable. The only time it's unprofitable is if it goes below 97. So you actually have a lot of scenarios where this trade will be profitable at expiration. And that's really why this is one of the more popular strategies amongst traders, is because you don't really have to have a strong directional view. Even if it moves a little higher, a little lower, you can still make money on this trade. But what that comes with is an inverted risk to reward ratio, meaning you're risking more than what you can potentially make on this trade, which is a little different than debit spreads, where you're risking less to potentially make more. So that's the difference between trading credit versus debit spreads. Next, let's take a look at the bearish example. So same XYZ stock trading at $100. Let's say I think the stock may move a little lower or stay where it is. Here's where I can sell a short call vertical, so the bearish credit spread. So here we're basically doing very similar strategies, but except what I'm going to start off is I'm going to sell a $100 call, and let's say I collect $4 for that call. That has unlimited risk to the upside. If the stock continues to go up and up, I'm going to lose money on that short $100 call. So in order to cap my risk, what I'm going to do is I'm going to buy a 110 call against that. And let's say that cost me $1. That brings my net credit again to $3, because I've collected $4 on the short leg, I've paid $1 on the long leg, which brings my net credit to $3. And again, the width of this vertical spread is again $10, because the distance between the $100 call and the 110 call is $10, which means that if my max reward is $3, then again, my max risk will be $7, the remaining of the $10 width. So whatever your reward is, that will cut into your max risk. And this strategy, just like the other trade, will actually be profitable as long as XYZ stays below 103. So this means that even the stock stays where it is, moves a little lower, or moves even a little higher, I'm going to be profitable on this trade. The only time this strategy will be unprofitable is if this trade goes above 103, or if the stock goes above 103 at expiration. So there's a lot of, again, leeway where there's multiple scenarios, whether the stock stays where it is, a little higher, a little lower, where it will all be profitable. However, the trade-off between having lots of profitable scenarios is that when you are wrong on this trade, or if the stock does jump higher, that you do end up risking more than what you're collecting in the premium on this specific trade. So making sure you understand that risk to reward ratio is important, because a lot of people chase credit spreads because they have higher probability of profits, but understanding that higher probability of profits comes at the trade-off of having bad risk to reward ratios. As long as you understand that, that's the most important piece. So now that we've talked a little bit about the construction of credit spreads, I want to talk about, generally how they're used. So number one, credit spreads tends to be better on ETFs and index options versus individual stocks. And the only reason I say this is because ETFs and index options tend to have smaller jumps, so that they don't tend to have big moves, because big moves is really something that doesn't really help credit spreads. Credit spreads work better when stocks don't move very much. So ETFs and indices tend to be the instruments that don't move as much. We tend to find that expirations 2 to 5 weeks out is generally the time frame that you get the best returns for credit spreads. This is really because shorter dated options maximize the time decay. This is what you're looking for when you're selling credit spreads. We have some research to show this as well. And then lastly, when you're selling credit spreads, you always want to sell out of the money credit spreads, or so you want to sell an at the money and then buy an out of the money, meaning the strikes, generally speaking, should not be in the money when you're selling these credit spreads. Sometimes it's okay to have the short leg just around the at the monies or slightly in the money, but generally you want to make sure that you're not selling something that's way in the money. So when you're selling strikes that are somewhat near the current price, what you're going to get is a lower probability of profit with better risk reward ratio. Some of you that sell credit spreads like to sell credit spreads that are really far out of the money. And what this does is it gives you very high probability of profit. And I think this is why a lot of people sell very far out of the money credit spreads, is because many times this will have 90, 95, even 98% probability of profit. And that, generally speaking, sounds really good. However, the trade-off with that is that you're going to get extremely worse risk-reward ratios. There's nothing wrong with that. It's just as long as you understand that trade-off, that's the important thing. So this is really that trade-off I'm talking about, the difference between probability and risk to reward. I just want to put some solid numbers around this so that you guys are familiar with these types of probabilities and risk to rewards. So what we have found is that there's generally two types of credit spread traders: traders that trade near the money credit spreads and traders that trade far out of the money credit spreads. So when you're trading near the money credit spreads, you're typically doing something like where you're selling an at the money call and then, or a call or put, and then buying back maybe a 20 or 25 delta call or put against that. For those types of trades, you're generally going to see probability of profit numbers that are somewhere in the 67, 2/3 range, if you will. And these will generally have risk reward ratios of roughly where you're risking $200 to make about $100. So 1 to 2 risk to reward ratio. Those are the typical credit spreads that we see a lot of traders trade on individual stocks. Now, a lot of ETF and index options traders, they like to trade far out of the money credit spreads. This is when they're buying or selling maybe a 15 delta call and buying back a 5 or 10 delta call or against it. You're going to see much higher probability of profit numbers. So this is where we see a lot of people chasing those 90, 95% winners. But on the back of that, it's really important to understand that you are then going to be risking sometimes 10 times what you're collecting on that trade, which means that you could be right 10 times in a row, which sounds great, but that 11th trade that ends up being unprofitable, you will wipe out the previous 9 trades before that. So as long as you're understanding that trade-off, that is the thing that I want to make sure everyone understands, is the trade-off between probability and risk to reward. Don't just look for high probability, or don't just look for high risk to reward. You want to make sure you find a balance between the two. So in trying to search for this balance, what we did is we did a lot of back testing. We tried all different types of deltas, different expiration dates, and what we really after thousands and thousands of backtests from S&P 500 stocks over the last 10 years, we've discovered that with credit spreads, the best strategy to do is the best rule of thumb is to collect roughly 1/3 of the distance between the two strikes. What does that mean? Is that if you're selling a credit spread that's $3 wide, so the distance between the two strikes is $3, you should try to collect roughly $1. And how do you collect $1? It's by adjusting how far in and out of the money those strikes are. So roughly 1/3 of the distance of the width is roughly what you want to collect. And that's the rule of thumb that we have found is the best case scenario. So we also found, for those of you that are interested in these types of strikes, is that roughly translates to selling roughly an at the money strike and then buying back about a 25 delta against that. That's where you're going to get roughly 1/3 of the distance between the two strikes. I'll show you guys that in a few seconds with some real examples here. And I will answer any questions at the end regarding the strategy, but the rule of thumb here is you want to collect roughly 1/3 of the distance between the two strikes by adjusting how far in and out of the money those two strikes are. And I just have a list here of all the different credits that you would receive with common strikes that you would sell. So we'll be taking a look at QQQ in a few minutes, looking at some $5 wide strikes where we're going to roughly try to collect about $1.67, and how to find those strikes. We'll show you that how easy it is to do that using options play in a few minutes. So that's the optimal credit spread that we have found based on all of the back testing that we've done that gives you the highest return in the long run. So now that we talked about the construction of credit spread, what are the optimal credit spreads, it's really important, I think, for me to sit down and discuss when to use credit spreads, because this is not a strategy that you should use all the time. This is only useful for certain scenarios. So number one, this is generally best for neutral or modest moves. So meaning if you expect the stock to stay where it is or move slightly higher, this is generally the best time to use credit spread. So when you don't expect a big move, that is the best time to use a credit spread. Many of you use technical analysis for trading. I know many of you use technical analysis because we've done webinars and you guys have responded pretty heavily on that. And that's actually going to be the webinar we're doing next week. But understanding many of you use RSI, stochastics, MACD, these types of overbought and oversold indicators. These are prime indicators to use for credit spreads because they help you identify when momentum is reversing, and that allows you to enter into a credit spread. And we're going to go over a few examples of that today. Lastly, tops and bottoms, also very good times to use credit spreads. So if you expect a stock to bounce off of a support level and you don't think it's going to go any lower, that's a good time to enter a bullish credit spread. If you feel that the stock has reached a top, maybe it's formed a double top and you don't think it's going to continue going any higher, that's a good time to enter a bearish credit spread. So these are the types of conditions and signals that you should be looking for to enter a credit spread. And lastly, once again, do not use them when you're expecting a large move because a credit spread is really not going to be able to take advantage of a large move. You're much better looking at debit spreads if you're expecting a large move in the underlying stock. So with that, just to reiterate, if you're bullish on a stock, meaning if you feel that it's oversold or it's hit a support level and you think it's going to bounce or move a little higher, you want to sell a put credit spread or a long put vertical. And then if you feel the opposite where it's overbought or reached the top, you want to sell a call credit spread. And you can string the two together. If the stock hits a resistance level and you sell a call credit spread, a few days later it moves lower and hits the support level, you can sell a put credit spread even though you're still in that call credit spread. That's one of the beauties of credit spreads, is that you can do this over and over again on the same stock. Without necessarily even waiting for one trade to expire before you enter another one, which is quite different from debit spreads. You would almost never enter conflicting trades from a debit spread perspective. You would always exit one trade before you enter another one of the same symbol. So that's really why credit spreads is a very popular trading strategy, in my opinion, is because you can trade them all the time and you're constantly trying to collect that income. So with that, what I just want to do is illustrate the difference between buying a debit spread and selling these credit spreads. So, many of you may have seen this chart before, but I think it's a very good illustration of the difference between a debit spread trader and a credit spread trader. So debit spreads are really useful when you're expecting a large, fast move in one direction or another. So especially when you have a stock that's breaking out of a range and you think it's going to make a big move, that's when the ideal time to enter a debit spread, because a debit spread will allow you to capture that large move with a very good risk-reward ratio while risking a small amount of money. Conversely, credit spreads are better for when you're expecting a stock to really trade within a range and not move a whole lot, or when you have a high probability of the stock just not moving any higher or not moving any lower. So you would sell credit spreads near the bottom when these stocks have reached its oversold indicators, because oversold is basically telling you there's a low probability of this stock continuing to move lower. So there's a high probability of that stock moving higher. The only difference with these indicators is that it doesn't give you a sense of magnitude. So the stock could move a little higher, but it could just move, let's say, 5 cents higher, 10 cents higher, 15 cents higher. Sometimes that's not enough to trade a debit spread, and that's why credit spreads are useful, because even if the stock just stays where it is, you'll be profitable on that credit spread. And that's the distinct difference between trading debit versus credit spreads. Debit spreads tend to be large magnitude trades. They may not be very high probability, but credit spreads are high probability, but there's not a lot of magnitude behind these moves. And that's a key difference between trading debit versus credit spreads. So lastly, what I want to do is I want to just discuss kind of what are the best practices for managing a credit spread once you're in that trade. So risk management in any strategy is absolutely key. And it's really quite simple on a credit spread perspective. Number one, you want to enter this trade when you're expecting a top or a bottom. How you figure out that top and bottom will differ from each one of you. Some of you use support and resistance lines. Other of you use technical analysis, such as the overbought, oversold indicators. Some of you like to just draw patterns on the charts. However you discover or find tops and bottoms, you want to enter these trades at those tops and bottoms. And again, you can string these call and put verticals together. You don't have to wait for one or the other to expire before you enter another one. So that's really the key of entering credit spreads. And once you're in those credit spreads, how do you manage them? Number one, the goal of a credit spread is to allow them to expire worthless. Keep the full credit that you've sold the spread for, and essentially do it again over and over again. That's the goal of selling a credit spread. However, we do find that there are some times where you want to exit a trade at a loss because you have this negative risk to reward ratio on a credit spread. If a trade starts to go against you, you may want to cut your losses so that you don't risk all of that, $7 out of a $10 wide credit spread. You want to make sure that you have some way of potentially stemming that loss at some point. So depending on how much you've received in the premium as a respect to the vertical width. So in the example before where we're selling a vertical width of $10 wide, if you're collecting anything more than $2 of that $10 wide spread, you want to cut your losses if you've lost anywhere from 75 to 100% loss of that trade. However, if you're collecting less than 20%, so this is for those of you selling very far out of the money, high probability trades, this is where you're collecting maybe only $1 while risking $9 out of a $10 wide spread. You want to cut your losses if you've lost anywhere from 100 to 200% loss on that specific trade. So you have to give yourself a wider margin because you're collecting such a small portion of the total vertical width. So that's how you typically manage your credit spreads. So let's actually jump over to options play because I want to show you some real examples of this. And then what I want to do is actually show you the launch of our new credit spreads trading system or trading signals, so that for those of you that are interested in getting some of our analytics for credit spreads, you can sign up for that, and I'll show you that in just a few minutes. So what I have here is QQQ. This is many of you that have been following the markets over the last few days are probably looking at this symbol. This is the NASDAQ 100 technology, NASDAQ 100 index ETF. Had a huge sell-off yesterday. It looks like it's bouncing back a little today. This, in my opinion, looks like it may be a bottom. I'm not saying that it definitely is, because I do think that there's still quite a bit of downside risk. But perhaps yesterday was shook out some of the weak hands, and maybe there's going to be some buying coming back into the markets. Hard to say, but it certainly does look like it could be a bottom here. And because of that, these are ideal times to potentially buy, sell a put credit spread. So what I'm looking at is I'm going to first click on I'm bullish for QQQ. And what I'm going to do is I'm going to modify this using our strategy constructor to construct a put vertical. So I'm going to select bullish. I'm going to select a short put vertical. And I'm going to change the expirations to November 23rd, which is roughly 30 days out. So in that 2 to 5 week range that we talked about. And we said that we want to collect roughly 1/3 of the width. So what I have set up is a $5 wide spread. I'm going to start off on a $5 wide spread, and I'm just going to keep moving the strikes until I collect roughly 1/3 of that, which is $1.67 or so. So I'm going to keep moving the strikes down until I get to roughly about $1.67, which looks like I'm there right now by selling a 170 put and buying a 165 put. So if I look at the midpoint on that trade, it's exactly $1.67. So that's how I'm able to find roughly the optimal strikes, is again by defining my opportunity, which is the distance between the two strikes. So I've selected $5 here. You could select a different spread. You could select a $3 wide spread. I'm just looking at a $5 wide spread, and I'm always trying to adjust the strikes so that I collect roughly 1/3 of that distance. So for me in this particular case, that looks like selling the 170 put and buying a 165 put. If you actually look at the deltas on that put, I bet it's pretty close to selling a 50 delta put, which is, 170 is pretty much the at the money put because it's trading at 169.77. And I bet the 165 is roughly about a 25 delta. And that's really what's going to get me that golden ratio, which is 1/3 of the width that I want to collect in premium. So let's take a look at the P&L simulator. I want to take a look at what different scenarios can play out and how the strategy will perform. And what I'll do is I'll compare it to buying the stock versus selling this credit spread versus maybe buying a debit spread. So this is really, again, for when you expect that the stock is kind of bottomed out. You don't necessarily know that it's going to move much higher. It may move a little higher, but you're not sure. You're just pretty sure that it's not going to continue moving much lower. That's really the ideal time to sell a put credit spread. So let's take a look at this. It's trading on 169 right now. What happens if after a while it just trades sideways or trades within a range, let's say between 170 and 176? So let's say it stays around 174 or so at expiration. As you can see, if the stock moves to 174 at expiration, if I bought the stock, I'd make a 2% return. If I sold this credit spread, I received the full credit of $1.67 while risking that $333, so 2-to-1 risk to reward ratio, but I keep all $167 as my credit. But if I bought this debit spread, as you can see, I actually lose $158. So again, that's why the debit spread is not something that you want to do if you expect only a small move in one direction or another. Debit spreads are only useful if you're expecting a large move. So if I expect the stock to really take off, let's say you think the technology is going to bounce back and you think it's going to go to 178 or 180, then you can see how trading this debit spread is going to give you a better risk reward ratio than selling a credit spread, or even higher. As it goes higher and higher, this debit spread is able to take advantage of that, versus the credit spread will still be capped at $1.67 in terms of absolute return. So that's really where you can utilize our tools to set up all different types of scenarios. You can even set up different credit spreads. So a lot of times you might want to play around with different widths. So instead of selling a $5 width, maybe we look at, let's say, a $3 width. So let's take a look at, on a $3 width, I want to collect roughly $1. So I'm going to keep moving these strikes until I get to roughly about $1. So as you can see here, this means I'm selling a 169, 166 put vertical. So here, instead of risking 333 to make 167, here I'm risking 200 to make 99. So same risk reward ratio, very similar probability of profits. So in this particular case, from a risk to reward metric, you're going to see lots of different strikes that's going to be able to give you this 2-to-1 risk to reward ratio. And it all depends on how wide you want to trade, meaning how much risk do you want to take for that reward. So here I have a $3 wide spread, a $5 wide spread, and maybe I'll take a look at maybe a larger spread. Let's say a $10 wide spread. Let's say I do 170, 160. Sorry, that was flipped. 170, 160. And for a $10 wide spread, I want to try to collect $3. So here, let's say I'd have to move the strikes a little higher. So for me to collect that 333, see, this is really where a $10 wide spread, in my opinion, doesn't look very good, because now I'm selling an in-the-money put. Let's see. No. 172, 162 and a half. Yeah, so on a $10 wide spread, it's because the strikes are not $10, are not 50 cents after $1.60. So it's hard for me to find that $10 wide spread. So it looks like $10 wide doesn't quite work here. So maybe I have to do a narrower spread. But this really allows you to create any size spread and be able to fiddle with the strikes until you collect roughly a third of the distance between the two strikes and find a strategy that suits you. And this is really designed to allow you to have that flexibility of trying out different credit spreads. The thing about credit spreads is that it really differs from debit spreads, because there's so many different strikes that you can trade that are still giving you the same risk reward ratio versus debit spreads. It's pretty solid in terms of how you select your strikes. With credit spreads, there's a lot of flexibility on your end to still get roughly the same outcome by using different spreads or different strikes. So there's a lot of playing around that you can do, and the best way to show you, or the best rule of thumb for you, is to make sure that you want to collect roughly a third of the width. As long as you collect roughly a third of the width, you're going to stay within the bounds of roughly what I'm talking about, selling an at-the-money call or put and buying back roughly about a 15 delta put, a 25 delta call or put against that. So with that, what I want to do is I just want to look at a few different examples here. Based on the new trading signal service that we're providing. So like I said, we have a pretty special announcement here for you for those of you who like to sell credit spreads. I'm actually going to take some of the samples in these StockTwits rooms as further examples that I'm going to show you guys today. So we are launching our new StockTwits Room Premium, where what we're doing is we're introducing credit spread trading signals for many of you that trade our daily plays. This is basically similar to that, but for credit spreads. And what we're doing is we're generating daily credit spread trade ideas. You can get phone and email alerts every single day, roughly between 2 to 4 p.m. Eastern is when we generate these alerts. And we're seeing an average return per trade of roughly about 11.2% on these credit spreads. Now, for those of you that are on this webinar, you should have received an email about an hour ago with the link on how to subscribe to this. But I wanted to show you guys a preview of this before you guys go ahead and subscribe. We have special introduction pricing for everyone. It's $39 a month for this credit spread signal service. And I want to show you guys what this looks like before you actually subscribe to it, because you actually don't see this if you just try to subscribe to it. You won't be able to preview it at all. So I wanted to show you guys how the signal service is going to work, what you can expect before you actually go and subscribe on your own. So here's an example of what the StockTwits Room looks like. It's basically a newer version of StockTwits, which allows us to enter a lot more text. We can do 1,000 characters and multiple charts per post. And this is a premium room, meaning it's only available for those of you that are subscribing. And really what it does is it becomes a two-way street. Instead of us just sending you signals, you can also send us your feedback. You can make adjustments to it and talk about it. It becomes a room for everyone to discuss these types of signals. And what we're going to be doing is we're going to be posting trade ideas using credit spreads every single day. My quants and I, what we've been working on over the last few months is, number one, developing technical signals that have high probability of moving in one direction or another. And then what we've taken is those high probability technical signals and crafted and back tested credit spread strategies on the back of those to bring you not only the technical signals, but also which credit spreads to sell. So here's a UNP example. This was a trade that was generated yesterday. It generated a buy signal on our weekly chart. And what we did is we constructed the optimal credit spread based on the methodology that we discussed here in today's webinar. So as you can see, here is a UNP chart. What we're generally looking for is stocks that are long-term in a bullish trend, however, have recently oversold or taken a big beating, and we think is going to correct back to its mean. So that's the general thesis behind our technical signals. As you can see, most of them have or every single one of them is usually above the 50-week moving average, but most of them are below, a 20-week moving average, because what we're saying is that this is a long-term bullish stock, but short-term it's maybe overcorrected a little and has a high probability of moving higher. These are the technical signals that we're looking for, and what we're doing is we're constructing the optimal credit spread to trade off of that. And what we provide you with is everything that you need to know which likes to sell, which likes to buy, what the max reward is, what the max risk is. As you can see, most of the ones that we target have roughly about a 2-to-1 risk reward ratio, exactly collecting a third of the width of the strategy. And it also allows you to just click on it and be able to see the strategy in options play. Not only do you see it in options play, we actually track for you how the trade is doing, so you can see not only the trade itself, a history of all the trades that we've generated, and be able to click on each one and see how they are performing. So this is really designed so that once you're a subscriber, not only do you get these alerts on your phone and through your email, but you also can reply back. So if you have comments or thoughts or questions on any of these strategies, we will be active in this room every single day between 2 to 4 p.m. and answering those questions that you might have regarding some of these credit spreads that we're generating. And this provides daily fresh ideas for you every single day, and a medium for you guys to discuss them with other credit spread traders as well. So at first, what we're going to do is right now, like I said, these are daily credit spread trading ideas. We started this about a week ago. It's been in a soft launch mode, and this is our first official announcement for this. And we have special introductory pricing at $39 a month. If you're on this webinar, you received an email from us about 40 minutes ago that has a link on how to subscribe. And just a little bit of details, this is built off of our back-tested technical signals. We back-tested these from 1999 to 2018. We tested these technical signals on credit spreads. So we, based on those signals, we optimized the credit spreads. And based on that optimization, we really found that golden ratio of collecting 1/3 of the width is really the spread that gives us the highest return from 1999 to 2018. These are all roughly 4-week expirations, so we're always selling credit spreads that are about 4 weeks out, and we always hold pretty much all of them to expiration. So we purposely designed these to make them as easy to manage as possible so that you don't have to constantly monitor these positions. These tend to be signals that we are comfortable with simply just setting and not forgetting, but understanding that we are comfortable with the risk to reward ratio that we're getting. So even in worst case scenario, we're willing to accept that the max loss on that specific trade. And lastly, what we expect to generate is at least multiple daily signals. Many of you, that follow our daily play have asked us for more daily play ideas, especially on days that we're closing trades. We're not sending out new trades. We've gotten some feedback on generating more trade ideas, and that's really why we decided to launch this service, is so that you guys can get daily signals every single day, regardless of whether we're closing a position or not. We're going to be sending out new signals using credit spreads. So basically taking everything that we're teaching here today, automating that so that you can get that in an easy to digest format. And for those of you that may not have gotten the email, you can look at this using stocktwits.com/r/optionsplay-signals. So with that, what I want to do is I want to just jump back real quick to a few other examples. I just want to look at Union Pacific. This is a trade that generated a signal yesterday. As you can see, this is a relatively strong stock that is kind of oversold recently. The stock really took a beating over the last few weeks as we had that huge sell-off in the markets. But as you can see, it really started to rebound a little bit yesterday. So this was the bottom that we kind of saw. As you can see, this 140 was a previous resistance level back here in May, April, broke above it, and then became support here in May, June, July, and then it kind of bounced off that level again. So this is kind of that bottoming that what we're seeing in Union Pacific. This is what's generated that signal, and off of the back of that, yesterday we sent the signal to sell the 141 put and buy the 135 put, and that collected $1.99 in premium with a risk of $4.01. So roughly, again, that 2-to-1 risk reward ratio. So everything is set up for you. We find the technical buy signal. We find the credit spread that we tell you to sell. We give you all the metrics so that you can decide whether this is suitable for you. You can do your own research on the underlying stock, see if you agree with us. And then more importantly, we give you a link so that you can immediately look at the P&L or the risk reward ratio within options play, see if it's a trade that you want to place, and if it is, you can go ahead and click on the trade button to get the details on how to enter this trade into your broker's platform. So we send these out again at around between 2 to 4 p.m. every single day during market hours. That was the other thing that a lot of people asked us to do, is send out daily plays or trade ideas when the markets were still open so that you can execute those trades immediately. So one of the great things about options play StockTwits signals is that when we send these out as an alert, you can either get a notification on your phone if you have the StockTwits app on your phone, or if you have email alerts set up, you can actually get an instant email the second we send out these alerts. So you're getting real-time alerts both on your phone and in your email so that you can action these immediately. And again, we send these out roughly between 2 to 4 p.m. Eastern every single day so that you have time to react to these before the market closes. So the other one I want to take a look at is Kroger. Here's a stock that kind of has been doing quite poorly, but recently started to turn around. When I say recently, I mean in 2018. As you can see, it started to make, these are weekly charts, by the way. As you can see, it started making higher highs and higher lows, and the moving averages crossed over from the 20-day crossed above the 50-day this year and starting to move a little higher, and it kind of bounced off this 50-week moving average and is starting to move higher. So what we were looking at is Kroger as a trade here, and what we saw here, if you look at a shorter term chart, again, very strong stock, meaning it's got a technical score of 9, so very strong stock, but recently kind of bottomed a little here around this $26, $27 support level that we found, as you can see, bounced off that level. Looks like it's starting to move a little higher. So these are the types of higher probability moves higher that we're expecting. So what we did here yesterday is we sold the $28 put, bought the 26 put against that, collected 65 cents, which is, or 70 cents at the time, actually, I believe. Yeah, 71 cents at the time, which actually gives us a risk reward ratio of a little better than 2 to 1. So again, you get the signal of which stock to look at, why we're looking at it, and then more importantly, which credit spread to sell off of the back of that. So this is really designed to take a lot of the work of researching which stocks that are bottoming or finding that oversold signal out from your work, because we are generating a lot more signals than we are generating credit spreads, because a lot of the work that you do, sometimes you might find a stock that you think is bullish, but you're not able to find the optimal credit spread for that, or you're not able to find a credit spread that meets your risk reward ratio. So what we're doing is we're doing all of that work for you. We're only showing you stocks that have generated a technical buy signal and have met some of the criteria that we're looking for from a credit spreads perspective, and only showing you those so that you have a very limited list to look at of ideas, but there's still multiple ideas that you should be getting every single day. So with that, what I want to do is I want to open this up for Q&A regarding any questions you guys might have regarding either the presentation that we've done on credit spreads, so talking about optimal credit spreads, when to get into those or not, and lastly, for those of you that are interested in this credit spread trading service that we're providing, let me know if you have any questions regarding that. So please, if you have any questions, please type them into the chat window, and I'll answer as many questions as I have time for. Stuart's asking, what date is the chart you are showing? It does not match up with today's trading. Does it not? November 25th, October 25th. I believe it's matching up with today's trading, October 25th. Would you please do an example with CGC comparing the debit spread versus the credit spread for January? Sure. Canopy growth. So let's say you think that this stock is bottoming, which, it certainly is sitting right above the support level. So that's certainly an interesting time to look at a debit spread versus a credit spread. So first I'm going to select I'm bullish. Let's take a look at a bullish credit spread, or you wanted to look at January. So let's say I buy the 45, sell the 52.5, which is a debit spread that I can trade, versus selling a credit spread. So the difference between these two strategies is, let's say I'm going to do a $5 wide spread. $5, I want to collect roughly a third of that. So here, if I sold the 35, bought the 30, I'm going to collect roughly a third of that. Maybe I can get a little bit more aggressive on this high flying stock. I'll sell a 37.5, buy a 32.5. What that means is I'm collecting $200, risking $300. Here I'm max reward is $880 versus max risk of $370. And just to compare apples to apples here, let's say I'm willing to risk, I don't know, $2,500 on each one. So now let's actually compare apples to apples. So it depends on how far you think Canopy is going to go. If you think it's going to stay where it is, around $40, $42, as you can see, clearly the credit spread is the winner here. So if you think the stock's just going to sit near the support level and not really move anywhere, that's when you want to trade the credit spread. But if you think the stock's really going to make a big move, so if you think it's going to go up to back to 55, which with these wheat stocks, I think that's very possible. As you can see here on the credit spread, you're still only going to receive that $1,600 versus a $5,200 reward on the debit spread. So again, if you're expecting a large move, debit spread's going to be the way to go. If you expect it to not move at all or stay where it is, credit spread will give you that better risk reward. Regarding credit spread trade entry, why not mention when IVR is high? That's a good point, but the reason that we don't mention that is because when you only sell credit spreads when IVR is high, in this particular case greater than 50%, you are filtering out more than 3/4 of all trades or of all potential trades, which means that you're missing out on a lot of trades. So we found that when you just do it when it's high implied volatility, you certainly get slightly better returns, But when you get slightly better returns, but you lose out on 70%, 75% of the trades, it's not worth it. That's why we don't use implied volatility to decide when we enter. Implied volatility rank is only useful if you're if you have multiple choices and you're trying to find which one gives you the highest return. You can use implied volatility rank to say if you have 4 different credit spreads and you're not sure which one to do, sure, you might want to do the one on the highest implied volatility rank. But by only doing implied volatility rank, you lose out on a lot of trades, and that's why we don't do that. Myron, you're saying you were charged $50 instead of $39. Please send me an email on that at info@optionsplay.com, and I'll look into that for you. Mike, do we have to buy options play software? You do not in order to sign up for the signals. Okay, so if you sign up for the signals and you don't have options play, what you can still do is view the strategy, but you won't be able to modify it and change it and utilize the platform. You can still view the strategy in options play, so you do not need to be an options play subscriber to subscribe to options play signals. Great question. If the recommended trade goes south, do you recommend a roll? No, because once the trade goes south, that means our initial assessment of the stock being bullish is no longer true. I would not roll that trade. That's not the goal of this. This is meant to just simply hold it to expiration. If it goes in your favor, you collect the premium. If it goes against you, you have defined risks to the downside. Explain the 75 to 100% risk. I think the question here is regarding the cut your losses. I think, is that what you're referring to? This means that if you're collecting, let's say $2 on or let's say $5, just let's say $1 for round numbers. Let's say you're collecting $1 in credit, so that if that credit is now trading at $1.75 or $2, that's when you want to get out, because instead of going in your favor where that credit is going to zero, which is where you're collecting all that money, it's going the opposite direction. So you're losing money on that trade. So if you've collected $1 and that spread now is trading at $1.75 or $2, then it's time to potentially cut your losses and get out of that trade. Any chance that any credit spreads will be shared in the daily play? So no, we will be splitting this up, because daily plays are, like I said, because credit and debit spreads are very different. Debit spreads are designed to take advantage of big moves, and that's what our daily plays are designed to do. We don't want to mix the two, because the two are completely different strategies. Credit spreads are designed for high probability, fairly neutral moves, versus debit spreads are for lower probability, high magnitude moves. So that's why we won't be mixing the two, if you will. Ron saying, just saw the webinar and joined in. When and where will I be able to see the whole presentation? So we will be sending out the recording about 30 minutes later with everything that I just sent out, including the slides. So for those of you that want the slides, make sure you take a look at the recording, because we'll send out the slides with that. Should the opening and closing trades be done on a combined basis or as separate legs? Really, really good question. All of these debit and credit spread trades should be done as a combined strategy. They should never be done as a single leg. Should the spread be with a plus or minus 1 standard deviation? Serge, if you could just clarify for me what you mean by that. I'm happy to answer your questions. Do you have to subscribe to Options Play as well? No, you do not need to have an Options Play subscription to subscribe to the credit spread trading signals. Ron, thank you so much. I really appreciate that. I have Options Play annual subscription. Does this include access to StockTwits Room? No. So StockTwits Room is going to be a separate service. We will be introducing a free room. They will not have these trading signals included in the free room. The free room will just have commentary on what's going on in the market, what we're seeing. We will post some trade ideas in the free room, but they will not have these credit spread trading signals. This was a room that we specifically created just for these types of trades. For StockTwits, is it just for US markets, or do you have it also for Montreal Stock Exchange? So currently StockTwits is only for the US markets. Is this service included in your existing monthly services or in addition to it? This will be in addition to that. This is not included with your Options Play subscription. These are two completely separate things. I was asking about CGC for January 2020. Oh, well, the analysis is exactly the same whether you're doing it for 2019 or 2020. It really depends on, do you think the stock's really going to make a big move? Generally speaking, you won't. It doesn't make sense to sell a credit spread that expires 2 years from now, because the theta on that is almost nothing. You're going to collect nothing on that for the foreseeable future. I wouldn't recommend you selling a credit spread that expires 2 years from now. Will it be recommending daily expiration trades? I'm not sure what daily expiration trades mean. The credit spread will always be selling roughly 4-week expirations. That is what the credit spreads trading service will provide. When the VIX is so high, is debit or credit spread better? That's an overgeneralization of volatility that I don't think is fair to say that just one strategy is better than the other, because again, it really doesn't depend on volatility as to which one's better. It depends on how far you think the stock's going to move. If you expect a large move, directional move, debit spreads are going to be better regardless of where volatility is. If you expect a neutral move, credit spreads will be better, again, regardless of where volatility is. There's the volatility exposure that you have on any of these trades are much, much smaller compared to the directional exposure that you have, delta. That's really why we always suggest you to look at your directional magnitude as your indicator as to whether you should trade debit versus credit spreads, not volatility. Are you going to add in debit spread signaling? Great question. So off of the back of the work that we've been doing on generating these credit spreads, we have looked at how to incorporate debit spreads into these signals. It's not something we're ready to launch yet, but it is something I'm working on. And I expect to have some more data for you guys, hopefully in the next month or so. And if we do, we'll do a similar webinar just on debit spreads and launch a brand new service for debit spreads as well, for those of you that like to trade debit spreads more. What is the total cost for options play in the signal service? So options play is $50 a month or $500 a year, and the signal service is part of an introductory special right now. Is $39 a month. Will you be recommending adjustments to the trades that are going the wrong way? So like I said, these trades are fairly defined risk and reward when we go into it, so we generally don't need to make adjustments to it. But if we need to, yes, we will alert you within that service. How much is the cost of options play? It's $50 a month or $500 a year. Do you send an alert when you close the losing position, or do I need to manage the trade? So the whole point of this signal service is that every single alert that we send out, we will send it to you through this service so that you don't have to necessarily know how to manage these trades. But like I said, these trades are designed to be simply held till expiration, either at a profit or a loss. So you need to make sure that you're comfortable with both sides, meaning you should be comfortable with the amount of risk if you were to lose all of it. That is the premise of these trades. Any trial period? So you do have a trial period for options play. You have a 30-day trial period. There is no trial period for the credit spread trading service, which is why, again, I wanted to show you guys today what it looks like so you can see what you'll get out of this. So here are, for example, all the trades that we've sent out over the last few days, so that you can see what the format of it is, what you're going to receive, exactly what the chart is, which strikes to sell, which strikes to buy, what your max reward, max risk is, and the link to the trade within options play. The credit spread trading is priced at $39. Is that Canadian or US? That would be US dollars. The risk reward profile much lower than debit spreads. I'm surprised to see 67%, 33. Leo, I think you mean the inverse. Debit spreads are usually 33% probability of profit. Credit spreads are the inverse of that, usually 67% probability of profit. They're certainly not the same. They're the inverse of each other. Do you close credit spreads on day of expiration, or do you let them expire? So we generally prefer to let them expire worthless. But if you're in the money and you're concerned that your brokerage firm is going to either end up buying some shares in your account for that, that's when you do want to close it. What I haven't announced yet is something that we are in the works of doing, is we are going to be partnering with Tasty Trade because they have a pretty good program for those of you that sell credit spreads, because they allow closing trades commission free. So many of you that sell credit spreads near expiration where one leg is in the money, you want to close that out. We're going to be doing a partnership with Tasty Trades soon that allows you to basically enter the trade with relatively low commissions, capped at $10, no matter how many legs or how many contracts you do, but more importantly, allows you to close that trade at expiration commission free. So that's something that we're going to be launching in the next few weeks. I'm actually quite excited to show that to you guys, but it's not quite ready, but it's in the works. And that's really part of the reason why we wanted to launch this credit spread service first, so that everyone's familiar with this, can see the benefits of that, and then potentially even trade it commission-free at some of the brokerage firms that we are looking at partnering with. Will you have a service to straight call or put options? I don't believe so, because we don't believe buying calls and puts is ever the most optimal strategy for any views. Meaning, if you have a directional view, you're better off trading debit spreads than just buying an outright call or a put. Can you get the service along with options play? Yes, so you can certainly pay for both. They are separate services, however, so keep that in mind. We don't have a combined package for both. Will you have a track record for the new service? Absolutely. So the whole point of this is, by putting this in this room so that you can see every single trade and click on them and track them, is so that we can provide a detailed track record. That was another thing that a lot of people asked us for on our daily play. It's just that got a little too difficult for us to keep track of that manually. So now what we're doing with this new service is we're trying to automate the process of tracking all of these trades for you, so that you can get weekly reports of how these credit spreads are doing. Debit spreads and credit spreads go hand in hand. I hope StockTwits will include both for those who sign on now. So yes, like I said, based on the research that we're doing right now for credit spreads, we do see some promise on debit spread trades, but I just don't have, I'm just not ready to launch that yet. But my quants are working pretty hard on looking at how to incorporate debit spreads into this type of strategy. Was your backtesting ratio for gains versus losses to obtain the 11.2% average return? Yes, and we used the correct return calculation for debit spreads. A lot of people will calculate the return of a credit spread as 100% gain if you collect all of the premium, but in reality, it's actually only roughly a 50% gain, because you have to account for the fact that you have to put up the full max risk as the capital to get into that trade. So if you're only collecting a third of the width, you're actually only getting about a 50% return on that trade. So we're calculating the returns of the credit spreads correctly based on the amount of capital you need to enter these trades. Is Tasty Trade a brokerage only for options? No, they trade all strategies. They just happen to have a commission schedule that's very, in my opinion, conducive for options trading. Is Tasty Trade available in Canada? I don't believe so, not yet. I spoke to Tom Sosnoff. He seems to be in the process of working on that, but as of right now, it is not available in Canada. What is the P&L for year-to-date trades on StockTwits? So we literally just launched this week, so I will be publishing a track record soon for this, but we just don't have enough trades, and none of them have expired yet. So we can't publish a P&L for this yet. Raymond, thank you so much. I really appreciate the kind words, and looking forward to having everyone join in and provide their feedback on these types of strategies. Are the alerts available for all customers? Some service does not offer an alert service outside of the US. So the alert service is through the StockTwits app. So if you download the StockTwits app, you can turn on notifications, and every time we send an alert, you will receive that notification on your phone as well as through your email. Jay is asking, is there a renewal per month? Yes, it's $39 a month, and yes, you can cancel at any time. Is there an annual option for this? So currently there's no annual option. It's only month to month at $39 a month. What's the best pop for debit trades, I'm guessing, DT? So the best pop that we generally see on a debit spread is usually in the 40-45% range. That's about as high as it'll ever go. What is delta for credit spread? So like I said, the rule of thumb is to collect roughly a third of the width, but what that tends to come out to be is roughly about selling the 50 delta and buying back the 25 delta. Does one require subscription to the US options play to the new credit spread trading service? So no, you do not need to have an options play subscription to subscribe to this new service that we're launching. Myron, I remember on one of your webinars, you mentioned that you prefer debit spreads. Did you change your mind? That's a really good question. So I've always said historically on webinars in the past that debit spreads is my favorite strategy to trade. So I haven't changed my mind on it because, but there's value in credit spreads, right? And the value of credit spreads is very different to the value of debit spreads. And I think what I illustrate this fairly well on this particular chart, because debit spreads is only useful when you expect a large directional move. And I stick by that. Whenever you have a directional move in your mind, I think you should always use debit spreads. I find debit spreads a little easier to manage too, because I always like to risk less to try to make more when I'm correct, versus credit spreads is the exact opposite. You're collecting a small amount of money while risking more. I've always been, as a trader that's cognizant of risk, always shy about taking something that has more risk than what I'm potentially going to gain. However, credit spreads, based on the, at the end of the day, I'm a numbers guy. I had my team of quants work on finding technical setups that are useful for credit spreads, and we were able to find some pretty compelling research on technical signals, as well as finding the optimal credit spread off of the back of that. And because of that, I'm becoming more comfortable with trading credit spreads, because now I have the numbers to back up to show that this is a profitable strategy from 2007 to 2017. So this is really why I am spending more time trading credit spreads, because it does generate more signals than debit spreads. Please explain how UNP is a 2-to-1 risk-reward ratio. UNP. So I'm risking. Oh, sorry. Where's UNP? UNP. I'm risking $1. I'm risking $4 to make $1.99. So that's about $2 versus $4. That's how you get a 2-to-1. Is there a rule of thumb for debit spreads similar to 1/3 the distance of strikes for credit spreads? The rule of thumb for debit spreads is much, much easier. You buy about a 50 to 60 delta call or put, and you sell about a 15 delta call or put against that. So you don't have to worry about that. Debit spreads, in my opinion, are easier to set up, because the rule of thumb of what strikes to buy or sell is always the same, and the rule of thumb for closing trades on those trades are also a little easier to manage, because it doesn't matter how much you're collecting with respect to the width. Max reward 199, max risk 401, you lose 202. That does not make sense. More loss than you make. Well, that's exactly my point. You're risking double the amount that you're potentially making. That's the 2-to-1 I'm talking about. Do you trade iron condors as well? So iron condors is really just a put credit spread and a call credit spread combined into one strategy. So the reason that we don't trade iron condors is because a put credit spread is when you're bullish, a call credit spread is when you're bearish. An iron condor effectively means that you're bullish and bearish at the same time. And I don't know of any metric or strategy or a technical signal that tells you that a stock is both bullish and bearish at the exact same time. If anything, those two may coincide with each other a few days apart, which means that you might enter a put credit spread when you're bullish, and then in a few days later, you enter a call credit spread when you're bearish, and that combined together makes an iron condor, but we generally never trade them together. Do you trade credit spreads during earnings? Really good question. We have generally found that it's okay to trade credit spreads during earnings, because credit spreads allow you to take advantage of that implied volatility crush that happens after earnings, as long as you get the direction correct. So our research has showed that it's okay to sell credit spreads during earnings. It's not something that you have to avoid. Tony, the spread or the trade distance of, say, $5, should it be with strikes inside of 1 standard deviation? Yeah, so usually when you're selling credit spreads, especially the optimal credit spreads that our research shows is best, generally will be always within 1 standard deviation. Like I said, there's a lot of index options traders and ETF options traders that like to sell really far out of the money credit spreads that are beyond 1 standard deviation. And, the research behind that also is does show that it is profitable. However, we generally see that it's not as profitable as trading credit spreads that are within 1 standard deviation. allocation because of that really, really poor risk to reward ratio. When you get these fat tail events like we've had over the last few weeks, people that have been collecting $10, $15 while risking $900 over the last few years have been right 99% of the time. But the last few weeks, some of these guys have lost, a lot of money compared to what they've received over the last few years. So that's really why I find it more difficult to collect $10, $15 while risking 900 something dollars. Debit versus credit spreads based on your expectation. That's my problem. It is so clear what was best when looking at the middle of the chart, but at the hard right edge, I don't know what the hey to expect. Sorry, Ralph. I'm not sure I understand your question there. If you could just rephrase that, I would be happy to answer that. Guillermo, I will stick to your favorite strategy, debit spreads. There's nothing wrong with sticking to debit spreads. It's certainly one of my favorite strategies to trade, and as long as you can find high magnitude moves, debit spreads is by far the better strategy for that. Credit spreads, a lot of people like trading credit spreads because they like to sell for income. And it is still, it's based on the research that we've done based from our customers, it seems like more of you trade credit spreads than debit spreads. And that's why we wanted to offer a service for those of you that do trade credit spreads. Not saying that everyone has to trade credit spreads, but if you like trading credit spreads, this service makes the process of finding trades, finding credit spreads a little easier. Number of trades per day or week under the signals program. So we average anywhere from 1 to 5 a day. I'm trying to keep that number to a relatively low number. So even if we're getting 10 a day, we don't want to send out 10. We're trying to find the best ones out of those 10 to give you just 2 or 3 so that you're not looking at 10 different ideas. That kind of defeats the purpose of sending these signals. If you have to then spend another 50 minutes doing your research on which ones to trade, we want to be that selection criteria for you so that every single strategy that we're sending you is already vetted by us, both on the technical side as well as on the credit spread side. Will you use SPX and RUT in these signals? Yes. So we have all the indices included in the list of symbols that can potentially generate these signals. Percentage of ETFs versus stocks. So we have about 40 ETFs and indices in this list for these credit spreads. So hard for me to say the percentage, but we have the full S&P 500 list plus about 40 different liquid ETFs and indices that we have in the list here. Does this offer start tomorrow? This offer starts now. So you guys all have received an email from us about an hour ago with the link on how to subscribe. And you can start immediately. If you don't have that link in your email, you can always go to stocktwits.com/r/optionsplacesignals. Myron, thank you so much. I really appreciate this. Followed your link, but no subscribe button for the signals, only StockTwits. So if you go to StockTwits, to specifically this link, it'll first ask you to sign into your login to your StockTwits account. So for those of you that don't have a StockTwits account, you have to first sign up. Once you're signed in, you'll see a button here that says subscribe now. So you have to first create an account for StockTwits if you don't already have there, and that will allow you to subscribe now to this new service. Got here late. How many recommendations each week? How do we sign up? So you sign up either through the link that we sent you in your email, or you can just go to this link that's right here, stocktwits.com/r/optionsplacesignals. You must have a StockTwits account in order to subscribe. And once you sign into your StockTwits account, you'll see a button that says subscribe now. Is your ROI based on an annual basis or the period of the trade? It's based on the period of the traded. That's for Michael Walter. Will you be using mostly ETFs or stocks? So like I said, we have a healthy mix of both. We have S&P 500 stocks as well as about 40 different ETFs included in our list. So we have both. Your link and email does not take me to the $39 service, just the free version. Okay, I'm sorry if you guys got a different link, but the correct link is stocktwits.com/r/optionsplacesignals. We also have a room called Options Play, which is our free room, but that's not for what we're here to talk about here today. So we do have Options Play as a room for those of you that want to subscribe to that. But for the credit spreads that we're talking about is Options Play Signals. How long is the $39 offer available? So for now, we plan on keeping it at $39, at least for the first few weeks, as we kind of get things off the ground, start building a track record, a live trading track record, that is. We have a very strong back-tested track record, but until we create this live track record, we plan on keeping it at $39 for the immediate future. Having difficulty signing up. Please let me know if you guys have some issues with signing up. Happy to kind of walk people through. Do you have any other plans beyond monthly? So we're leveraging StockTwits for this, and right now they are only offering monthly subscriptions. We've talked to them about potentially doing yearly subscriptions, but for now this is limited to monthly subscriptions only. Can you use this for shorter term credits, but it's like 14 days? You certainly can, but we've tested a lot of different expirations as well. We generally don't have the same returns on shorter dated options. That's why we're going out 4 weeks. We found that it's better to sell those 4-week options because the gamma doesn't kick in until the last couple of weeks. And if you only sell 14-day options, you're going to have a lot more gamma risk on these credit spreads. Do you put on the other side of the credit spread like an iron condor? So right now we are only selling put credit spreads because put credit spreads give you a much higher premium that you're going to be able to collect on a put spread than versus call spread. You're just not getting the same type of returns on call spreads. So for now, this is limited to put spreads. Like I said, we are still researching potentially doing bearish trades, but if you look at any technical signals over the last 10 years, almost no bearish technical signals generates good returns because of the strong bull market that we are in. So we are not at this point selling call credit spreads to generate an iron condor. We are only selling put credit spreads at this point as part of this service. Any of your backtesting history available for view? We are in the process of putting this together into a full list of trades that you guys can review. I plan on publishing that in the next week or so. If you are interested in looking at every single trade we've ever generated off of our backtest, happy to share that with you. And I'm looking for input from you guys as well, especially some of you that are technically savvy that can help us with some of the backtesting. I'm even open to some help. But yes, we will be publishing a full list of technical signals as well as all the credit spread trades that we made during our backtest. Have you done any trades yet today? So no, we have not. Like I said, most of our trades are generated between 2 to 4 p.m. Eastern time every day. So that's when you get your signals. Problem to sign in. If you could let me know what problems you're having, I'm happy to walk you through anything. So like I said, options play signals, stocktwits.com/r/options play signals. Once you log in, you'll be able to click on subscribe. Cannot find how to turn on alerts. Stuart, why don't you send me an email at info@optionsplay.com and I'll see what I can do to help you with that. So Charles, what we've generally found is that a bearish indicator reversal does not end up being very profitable by selling call credit spreads. That's why we're not doing it. You can certainly try, but we've backtested thousands of technical signals on bearish ideas. It just never quite works out. So that's why we're not selling call credit spreads. Any other questions? I know this was a very long webinar, and I really appreciate for those of you that have stuck around for the full hour and 15 minutes, but we did cover a lot of things. No, you will not be able to see the alerts in Options Play. You will only be able to see the alerts here in the Options Play signals room. But you can subscribe to both phone and email alerts so that you don't necessarily have to have Options Play or StockTwits open. You can just get the alerts from our service. This is really one of the benefits of leveraging StockTwits, is because we didn't have the infrastructure to build out some of these alerting systems that they've built out for you so that you can get an instant real-time email and phone notification for that. How do we contact you if we have a problem signing up? So I just sent an email in the chat room. So info@optionsplay.com. You can send me an email there on how to subscribe to this signal service. Will the signal service in the future for debit spreads? Yes, like I said, we are in the process of researching that. We have some early promising results on that, but it's not quite ready for launch like it is for the credit spreads. But that is something that we are cognizant of, and we want to automate this as much as possible to generate as many signals that have, back-tested results to show that they are profitable for you guys. Any other questions? You will have a copy of this webinar in about 30 minutes. So please look out for an email in your inbox, and you will have a copy of the webinar then with the slides. So if there are no other questions, again, I want to thank everyone for taking the time out this afternoon. I hope you guys found this not only useful, but found this new service interesting. And if you have any questions about it, please send us an email at info@optionsplay.com. Happy to answer any more questions you guys may have before you go out and subscribe to this. Guillermo, Stuart, Serge, everyone, thank you so much. I really appreciate it. And next week, we have another very special webinar on technical analysis. For those of you that are interested in learning a little bit more about some of the technical analysis that we've been researching, I'm going to be sharing some of those insights of what we've learned from technical analysis and how you can apply that to trading index options. We'll be doing another webinar in conjunction with NASDAQ. So very excited to do that for you guys next week, and I hope to see you guys there next Thursday at 4:15 p.m. So have a great afternoon, and please let me know if you guys have any questions. Yes, the video will be sent out about half an hour after we're done here today. Okay, guys, I'm signing off, and I'll see you guys next week. Have a great afternoon.